Hello, and welcome to Managing Your Lien Portfolio in a Post-COVID World. In this presentation, we will hear three experts share their perspectives on how commercial lending is being drastically changed by the COVID-19 epidemic. David O'Connell is a senior analyst with IT Group, where his primary coverage area is lending. A former commercial lender of 14 years, Mr. O'Connell brings to his lending coverage extensive hands-on and granular knowledge of banks' challenges in building businesses that lend safely, cost-effectively, and at scale. He holds a BS in Business Administration from Providence College and an MBA from Boston University. Suzanne Constance is Vice President of Product Management and Marketing for Wolters Kluwer Lien Solutions. She leads a team focused on understanding and solving client problems and needs to create and go to market with innovative products and solutions that help clients mitigate risk and improve efficiencies. She earned her BA from Cornell University and an MBA from the Kellogg School of Management, Northwestern University. Boaz Salik is managing partner of Fisher Jordan. With over 2 decades of consulting experience in the financial services industry, his primary focus areas are risk analytics, investment optimization, and product strategy. Boaz holds a PhD and MS in electrical engineering from Caltech and a BS in electrical engineering from the University of Arizona. Today, our experts will examine the lending environment from 3 different perspectives. First, we'll look at the way things were pre-COVID, including the laissez-faire state of credit issuance over the past several years, which led to an abrupt correction as COVID hit. Next, we will examine best practices around securing your existing portfolio, including the need to think about loan portfolios more scientifically to maximize your ability to collect on defaults. And then we'll look forward to new loan originations and things to keep in mind as lenders enter the true post-COVID lending landscape, a landscape that will be full of scar tissue from the things we're experiencing now. We'll start by looking at some powerful data about how we have been moving toward a unique situation in commercial lending, to say the very least. Kicking things off is David O'Connell.
Thanks very much, Rob, and thanks everyone for being here today. I hope this webinar finds everyone in attendance with family and loved ones who are healthy and safe. These are indeed difficult times. I want to talk about a couple of things with regard to liens and the broader lending environment. There are 3 primary things on my mind that I want to talk about. The first is the overall credit environment in terms of its history, how we got to where we are. Where are we right now? Okay. I also want to talk about a concerningly high level of distraction that exists in the credit environment, given some of the concerns that we know are out there. I also want to talk about some bad behavior that I see going on by some folks in the credit market, both criminals or fraudsters, and also legitimate businesses who are committing credit fraud. But first, I want to talk about the environment that the credit cycle that sort of approached the COVID moment. And regarding that, I was in the very fortunate position a couple of years ago of surveying 501 credit-seeking SMBs. I was able to ask them a handful of really interesting things. We wanted to cut through a lot of folklore and myths that were going on out there. Ask them things about why do they apply for credit? When do they do it? How do they decide where to apply and where to close? And how easy or difficult do they find those processes? Okay. I happen to come from Boston. If you remember only one thing about the credit environment that we had in the very recent past, I'll give you this analogy. Okay. We used to have a famously corrupt mayor here in Boston. His name was James Michael Curley. And during one of his re-election campaigns, his motto was vote early, vote often, vote Curley. There was a lot of early and often going on in the credit market, okay? That data is right here. Smart folks in the audience are probably noticing that date of 2016. Yes, the data set is stale, but it paints a picture of the environment that we were in as we approached kind of the COVID moment. The first thing on my mind is that folks tended to apply for credit relatively early, okay? In fact, about 70% of credit-seeking SMBs did so weeks or months in advance of the credit need. They also, over a two-year period, tended to see credit a number of times, okay? So that's the early and often. A few other very interesting and compelling nuggets about the credit bonanza, if we could move to the next slide, please, were first of all, that the average loan size was just under 200,000. The loan approval rate was about 80%. And as we all know, interest rates were among the lowest that we've seen, certainly in economic memory, okay? And the basis for competition among lenders was primarily the elimination of every iota of friction from every process possible. That meant both onboarding and underwriting, and that meant that mistakes often got made, okay? So where does that put us now, okay? Where does that put us in terms of an overall market? And it's that we have a huge amount of debt out there. This chart is a crunch I did of some Federal Reserve data, and it basically shows us that commercial and industrial loans pretty much doubled from about 1.2 million to just over 2.4 trillion I should have said, as of Q1 2020, okay? Now, that point on the end of the chart is the COVID moment, okay? And it was a sharp moment. We all remember what we were doing that first week of March when COVID transformed from some scary headlines in Japan to a global pandemic, all right? And something that affects our everyday lives, all right? And it's already showing up in some economic data. If we could go to the next slide. Where are we now is that during Q1 2020, banks appear pretty concerned about their loan portfolios, as is pretty logical because we're worried about at least institutions like restaurants and gyms. They increased their provision for loan losses by about 280%. This means that they're expecting non-current loans and perhaps non-performers to be 3 times higher than they currently are, okay? I personally think that in a quarter or two, we will see a sharp upturn in non-performing loans and leases. And we've already seen, I think, a concerningly sharp increase in non-current loans. Just how sharp, you'll see in the next slide, which is a bit of a crunch of data that I did, bit of a crunch on data that I got from the FDIC. It's based on call report data, okay? And as is usually the case with PowerPoint, the thing you want to pay attention to is on the right-hand side of the chart. Those 2 lines are the sharply upward trend in quarterly percentage change in non-current loans and leases. The blue line represents ag because those are loans secured by farmland. The gray one is all non-ag, okay? 2 takeaways here. The first is how sharply upward those lines went in Q1 2020. And the second thing to take away is that 25% and to some degree the 11% are on a par with some pretty dark days during the global financial crisis, okay? The last thing on my mind is if we really kind of gaze at those lines, it looks like we might have actually been in a recession in Q4 2019. I always want to be careful to pause and get my quarter numbers and year numbers right, okay? Now, amidst all this, I'm concerned that there is more than a bit of distraction on the part of lenders in this environment. The first source of distraction, of course, is Triple P, okay? It was epic. It had huge scale, it had huge gravitas because its goal was to try to keep people from going out of business and individuals from not getting their paychecks. $512 billion in loans, 4.6 million loans booked by 5,500 lenders. Ambiguity, the types of which lenders are not accustomed to. The program came out on a Friday, and on the following Friday, there were still clarifications of guidelines coming out, and folks had to, kind of yank in-process Triple P loans out of their loan origination system, troubleshoot them, and put them back in. Okay, all under the COVID requirement of socially distanced lending, which frankly was kind of new to SMB lenders. The SMB lending world is a really, really neat place, okay, in general, and in particular the community banking world. This is a place where it's very common for lenders to have been in, lenders and their families, I should say, to have been in the community banking world for several generations. I recently hosted a panel about community banking, and two of my panelists had each been in community banking for 4 generations. The reason I bring this up is that in an environment where borrowers and lenders, probably their grandfathers were also borrowers and lenders to one another, okay? This is actually a hard environment into which to inject or induce adoption of technologies such as digitalization. So during Triple P, there was a rapid embrace, one could almost say a rapid marriage of convenience. I've been trying to find a more politically correct way to describe it, and I'm sorry, I hope that's not off-putting. It was not optional. It was rapid, it was painful, and as I said, because of some of the it was culturally challenging, because of the kind of favorable ways in which community bankers do this. And small banks played a really huge part. Just how huge? They carried about, and these two pie charts that I have here on the next slide, have small banks carrying 32% of the loans by dollars, and 38% of the loans by count, okay? So distraction indeed. And Triple P is not the only source of distraction for lenders. There are other things going on, okay? They are, and these anecdotes are not at all an exaggeration or a joke. They're trying to figure out how to use their drive-through, which they haven't used in years, as a pipe over which to close loans. They're trying to figure out, their branch. They don't want it to close because they field and close and handle a lot of small business loan activity in their branches, where, by the way, people have begun walking into the branch with handkerchiefs covering their mask. They look like bank robbers, and that's something that has to be figured out. With the deteriorating credit conditions that I mentioned a few minutes ago, they're distracted by credit quality research projects, more onerous renewals, and very heavy restructuring of deals that are kind of in trouble, okay? Nobody likes distraction, okay? Almost nobody. But guess who does like distraction? Criminals and credit abusers really like distraction. This chart right here is from an unrelated, but I think interesting data set. It's from a survey of 45 institutions lending to SMBs that I closed in late February, right before COVID turned into a pandemic, okay? And the point that's on my mind here is that one of the most pernicious forms of fraud is what's called loan stacking, okay? And that's when someone almost at the same exact time applies for not, let's say a business can handle $50,000 in debt, or maybe a criminal thinks maybe they can pull off a $50,000 fraud with some counterfeit documents. With loan stacking, what they instead do is they apply for $50,000 in debt 4 or 5 times, almost at exactly the same time. All banks approve the $50,000 loan, and boom, there's $200,000 or $250,000 in credit to that small business, and it's not going to end well. It reminds me of like an age-old sad story that banking that happens with pretty much every credit cycle, okay? And that is, things get bad in the economy in general, things get bad in a particular deal. The credit file goes to workout, and there's a grizzled old boomer like me, lady or gent, okay, who's been through 3 or 4 cycles. They open up the file, and a number of things are wrong, among which is something kind of like loan stacking. In other words, we thought we had the factory as collateral, and guess what? It got pledged multiple times. I now want to hand it over to Suzanne and Boaz to talk about how one might prevent this sad story from reoccurring for you.
Thank you, David. So I'm going to talk, there's some things I'm going to talk about that dovetail a bit with David's rendition of what's been happening, but I'm taking the perspective of a partner to lenders my background is I do come out of a banking background, and now at Lien Solutions, we're really partnered with most U.S. banks in helping them with their UCC liens, mortgage, and vehicle titling. So I'm going to take it from that perspective. So let's talk about the situation and some potential proactive steps that lenders can take in this environment. Let's move to the next slide. So there's three ways we're looking at what just happened in this country and in the world. None of us were prepared for it. A lot of us were making adjustments. I don't think in any period of my past have I used the word pivot as much as I have in the past several months with my team and with customers and with, with others, also in personal life, right? You have to do things differently. So we have to look at both where we are today, what has been going on, and how we move forward and try to position ourselves so we're not just reactive to many unforeseen circumstances, but we're also proactive. There's three different ways that we're going to break out some of what we talk about. One is, let's acknowledge the operational challenges that we have been experiencing as as organizations, and where we go from there, and what are some of the trends as a result of that. Let's look at some of the risk. David had already talked about the kind of risks that we're seeing. We really need to look at what that means for your existing portfolio as well as for the future, and how should we be handling originating loans going forward, and in particular, how do you use liens to mitigate your risk. So let's start with the operational challenges. You want to go to the next slide, and we can skip there. Here we go. So here's the perspective of someone working with the lenders. First of all, we had the lockdowns, right? The stay-at-home orders, and it was really interesting to see banks and financing organizations go through this. I know I have one friend who works at a New York bank, and she was still getting on the train and the subway and going into the office when our company had already gone remote and many places were. And the reason, they were struggling with how to handle this new environment because they just weren't set up for it. It wasn't in their DNA. So they were trying things like rotational programs and bringing in skeleton crews, things like that. Eventually, they did go remote. And we saw, within a few weeks of our going remote. And we saw, even with our existing customers, as they went remote, they had challenges like they couldn't all have their employees get onto the servers at the same time. They had to create a schedule because the servers couldn't take that many external connections. It wasn't something they were prepared for. At the same time, we work with both lenders and jurisdictions like secretaries of states and counties in order to help lenders get the information they need when they're determining how to make a loan and how to file a lien, as well as how to file that lien. And we found that those jurisdictions were also limited or closing. So really a big challenge. And it showed us all, it was sort of like pouring water into a cup and seeing where there are holes. It showed us all holes where if you're doing something manual or you're taking paperwork into your office through the mail and you have confidential information, that's where the pain points are. That's where the challenges are. And so during this process, our organization has automation and integration everywhere possible with jurisdictions, with lenders. We use e-signature. In some cases, our customers are able to decide whether they use electronic means or they do things manually, especially in sort of the mortgage area with recordations and e-signature. We went back to our customers anywhere where they were using manual processes, and we had automated ones and said, listen, at this point, we got to make the default electronic for you so you can get your business done. Within a few days, we had made 2,000 more connections electronically for our customers just by turning the switch and getting their approval. No one said no. So I do see a trend of both remote workers, some of the same banks that were very hesitant about having their workers go remote have now seen that this can work and could potentially be cost effective. And I also see a greater trend and acceptance of automation because we realize that can really help us when we can't be physically there. Now, as soon as the lenders got their feet under them, PPP struck, and PPP kept striking, right? Because it kept changing as the government would modify that to make it more appealing, to make it work better. There, I saw folks that I know who have nothing to do with that side of the bank. They might be in the deposit area. They were working over the Easter holiday to try to manually get those loans going. We had one organization say, normally in this time period, we would get about 300 small business applications. We got 30,000. How do we handle this? So that was a real distraction and challenge, as David said. Over time, some of these workspaces are opening, but they're not at 100%. So there's a lot of decisions that have to be made about what you do and what you don't do. We see lenders and jurisdictions trying to keep their head above water and just get done the most critical tasks. At the same time, there were so many inquiries from customers. I know that even personally trying to call my own bank just about matters around my account or getting a statement, you were on hold. They had numbers to call if you were calling about the PPP program. There were forbearance requests, loan requests based on the current environment. So just a lot hitting lenders at that time. And the day-to-day around looking at collateral in person, making sure that's verified, was also a challenge. So big operational challenges. I think the main themes out of this are remote is going to be a bigger part of our existence, and automation is going to be more required as a result of that. Let's keep moving. Let's talk about credit risk now. So this is a perspective on some of the main areas that lenders have to really focus on. In talking to some of the risk managers at lenders, one of the first things I think there were two things that came up pretty quickly. One is number one, which is, let me look at my portfolio and figure out how much, what are my percentages within different industries? How much do I have in hospitality and restaurants and commercial real estate versus technology or other areas? So there is a focus there in trying to mitigate some risk there. At the same time, as I mentioned, there's a lot of requests for forbearance and loan modifications. And then there's questions about what should the payment schedule be? How do we revise the interest rate? When do things get back to normal? So these are things that the lenders are all grappling with. While this is happening, because of those stimulus programs, we mentioned PPP, but there's also EDL, the emergency loans, now Main Street's coming out. There's a lot of credit being taken. There's some with Lien, some unsecured. There's a lot going on with different lenders being a part of that. So the whole environment is really changing. Being able to track and understand the borrower and understand how much credit they're taking is becoming more and more important. At the same time, some of the collateral that's being used is not potentially at the same value. So how do we look at that is a big question for lenders. And the provision for credit loss. That was another immediate thing that we saw our banks take into account. So as David mentioned, in Q1 of 2020, banks increased their provision for loan losses by 280%. And that makes sense because if you look as we go around the circle, when you look at defaults and charge-offs, we see net charge-offs grew. In the first quarter of 2020, they rose 15% from 2019. They're at $14.6 billion. Nearly 70% of those new charge-offs were related to commercial and industrial loans, and the C&I loan charge-offs grew by 87%. So there's a lot of work that is needed there. And if you look at number 5, and this is where we're going to focus along with number 3, lien perfection, making sure that you have your liens that perfection is really a word to just mean that they're actionable. That is going to be a big focus for folks as they look at their portfolios. So let's move on. Let's talk about how to address some of these challenges. So I think it was about 3 or 4 years ago, I was at one of our client advisory boards, and we have the biggest financial institutions all attend that and talk to us about their problems and how we can help solve them. And one of the VPs of document services for a major bank said, we know our cost benefit. We have a policy set for us around what kind of searching we do on borrowers, what kind of work we do before we finalize that loan, and when we do the backup work after the loan, and where we file liens. However, I think we do a good job in the beginning. I don't know over the course of 5 years if how good that portfolio of liens is. I don't have good visibility into it, and I know that there are things in the environment that can affect it. And that started, as we talked around the table, that really started our journey around lien management, around giving visibility, automation, analytics to lenders so that they can make sure that their liens will hold up for them and they understand when there are issues and they can be proactive about that. So I want to talk about some of those solutions so you have a perspective on this, because I think at this time in the marketplace, it's really important to be able to mitigate risk. Let's go to the next page. We'll hone in here. So lien analytics. So what is this? This is answering that first question that our customer gave us, which was, how do I know my lien portfolio is healthy? Liens are not set and forget it tools. Basically, things can happen with the debtor over time, and other liens that are made and so forth that can really change whether the liens are actionable. If you have filed a lien with a debtor name mismatch, for example, or in the wrong jurisdiction, or if that business entity status changes, that can all affect your ability to collect on debt when there is an issue with the loan. And we've seen things like examples of one of our customers had a debtor and the name had a space in it, and they did not put the space in that. And we found that for them, and we addressed that because there actually was another debtor or another company out there with the exact same name with a difference of the space. So that can make a difference, and you really have to protect yourself around that. So lien analytics is a portfolio that shows you things like those mismatches, shows you any issue that we think could potentially mean that your lien will not hold up, and allow you to then action on it, and we can help you with that. That's a service that we provide to our customers as part of the core capabilities. And let's move on to the next topic. This is debtor monitoring. So the way to think about this is, if lien analytics is a dashboard to see everything and to see any kind of problems and fix them, monitoring is really an alert. So we will let our customers know when there's an issue that has come up, something new, some new triggering event that happened. Now, something like 16% of debtors have a change event per year. So remember, we were talking about names and getting that right. An address change, a name change, or a change with their good standing status are all really important to be aware of for managing your liens and filing a UCC3 or extension kind of lien. So those are things that we do via alerts for customers. Let's move on to visibility. Now here's the big pain point that came up after we'd resolved some of those issues was, most lenders don't file all their liens from one place and have complete visibility into that. We have a lot of mergers and acquisitions in this space, so often there'll be different portfolios that are kept differently. There's different business units. But the other thing is, often we'll use lawyers on certain deals. Complex deals may have a lawyer who has actually filed the lien. And that was a pain point because over time, the lender needs to manage that, but they may not have visibility. And remember, those liens expire, and in a 5-year period, you have to extend them, you have to manage them, you might have to release them. So those are all things that are really critical to be able to see and to manage. We created a product called Portfolio Sync, and it was co-created with our clients. And what that does is it pulls in all the liens so that that lien analytic dashboard can include everything. It doesn't matter whether it was created through our own iLien product. It could have been anywhere, and we'll bring that all into that one view, let you action on it. Also, you can do monitoring alerts and have automation of different tasks, just like for the ones that are generated through the product. And that has been a really great efficiency play for customers, and just gives them the visibility that is required for them to be able to manage this kind of complex process. Now let's just talk about automation and integration. I mentioned that in the remote world that we're in, and which will, continue to some form, we think to a greater degree than it has been in the past, integration we believe will speed up. It has already been, I think, in the last year or so, really moving forward from what we've seen with our customers. But a couple of things to be aware of. APIs are really valuable right now, and they have been a focus of our development for the last few years, making sure we have state-of-the-art APIs for customers. So for those of you who aren't super technical, it's an application programming interface. That's what an API is. And the way to think about it, it's just a way, you're using them all the time. You use them when you're on eBay, you use them when you're on Amazon, whenever you're working with any of those merchants or so forth. It's really just a way for a computer system to simply and easily communicate with another system. We use those so that we can go into the loan origination system and just integrate our services right there for customers, so they don't have to worry about signing on multiple places, and they don't have information trapped in our product versus their loan system. They can just smoothly go in there, learn about their customers, search the information that they need through our services, but it looks very simple and fluid, and then can go right into filing liens or modifying liens as needed. Another thing besides APIs is we focus on automating some of the more routine tasks that you need to do with liens. So one of them, for example, is continuing liens. We allow our customers to have a default to continue all liens or just have certain liens, because who wants to put a tickler in their calendar for 5 years from now to extend a lien? When COVID hit, even though our customers have a dashboard to show the expirations coming due, we proactively went to them and gave them all the information on all their expirations that were going to happen, because we knew the jurisdictions were going to start closing and limiting their capabilities. And we also, we could automate doing those extensions for them for like the next 6 months or so while we saw what the environment held. Really important to be able to take those kind of actions and make them kind of bulk, quick actions to initiate. Let's talk a little bit about vetting borrowers. So as I mentioned, we have a surge in government loans right now. And secured parties are, seeing that many of their borrowers are receiving multiple loans. It's very important at this point to focus on search and to search the UCC so you can get that view on whatever liens are out there. Liens are still holding. They're really important. They will take the precedence in holding on the collateral. One thing to be aware of, like a kind of a nitpicky thing, but it's important, is the Secretaries of State provide that information at different, what we call currency rates. Sometimes they're pretty regular and up to date very quickly. Some of them are a little slower. So when you're doing those kind of searches and when you're looking at what kind of liens have been filed, look to see the date so you understand how fresh your information is. Another thing to be aware of is because there are different liens on collateral for that same borrower for multiple lenders, because our country definitely has folks taking loans from multiple lenders, there is a value in seeing all of that in one place. And I know that can be a very manual and laborious activity to try to go through the paperwork. It's not even surfaced very easily by the jurisdictions to see that. We have something called a Lien Insights report that we provide to our customers so that they can actually see all the liens against that same collateral that the borrower has, and that gives you a better perspective on where you stand and what the situation is. So just some ways to make things easier to automate and to provide some visibility that I think in particular are helpful at this time. Let's move to when I should file a lien. So Boaz and his team have done some quantitative work on looking at the current environment and how things may change around this just based on the numbers. So I'll pass this on to Boaz.
Thank you, Suzanne. I appreciate the summary and the introduction. One of the questions that we typically run into in working with commercial lenders is under what circumstances should we be filing liens on secured loans? And there are a number of considerations that come into play, including the size of the loan, the risk level of the borrower, and how many other loans they have, et cetera. One thing we often find is that the decision is often made informally. So typically there will be some kind of threshold set. And if the loan size is above a certain threshold, then the lien is filed at the time of origination. But if the loan size is below the threshold, then lenders often wait until something bad happens to the loan, whether it's a mispayments, a default, or a bankruptcy, and then they'll file the lien at that point. The difference being is if you wait longer to file the lien, you could find yourself being not in the first lien position. So you could be in a second lien position or even lower, depending on the borrower. Now, given the current environment, a lot of the factors that went into those decisions are now changing. And so we're seeing a lot of lenders actually go back and reevaluate what should that cutoff be, and should we be changing that cutoff given what's changing about the environment, including changes in the risk level of borrowers, incremental loans being offered both through the federal government as well as the banks that they may be working with. And then just changes in the overall prospects of the business, whether it's current cash flow or expected future cash flow. So all those factors are kind of driving lenders to reevaluate, and they're complicating the decision on when and how to file liens. If we can go to the next slide, please. So one thing that our team was able to do together with Lien Solutions is to actually formalize the cost-benefit framework for when and how to file the liens. And specifically, if we look at the chart on the left, we ask ourselves this question. So if my lien filing threshold was at a certain level before COVID hit, what should the new threshold be now that we're in this COVID environment? And so what we were able to do is take a lot of the cost components of filing a lien, whether it be operational costs, legal costs, filing fees, state and local filing fees, et cetera. So we factored all those in. And then the second thing is, what's the incremental benefit of securing that first lien position compared to not having it if you file later? And when we ran the numbers, you see the chart on the left. And what we found is that under the current environment, in all cases, regardless of what the threshold was before, in all cases, it should now be lower. And how much lower depends on what the prior threshold was, as well as a number of other factors. The chart on the right shows some historical data that was leveraged for this analysis, which shows that the incremental recoveries that you can expect from being in the first lien position can often be about 3 times as high as being in the second lien position. And it's even a larger factor for other lien positions. So given that portfolios are now riskier and there's more uncertainty about borrowers' ability to pay, we feel it's much more important to kind of reevaluate and potentially be much more conservative with when to file liens and at what thresholds. And we also feel that this applies in 2 areas. One is if the lender looks at their existing portfolio, we feel that now is a great time to go back and even if a loan doesn't have a lien on it yet, it's a great time to go back and reevaluate that ahead of what could potentially be, as David mentioned, a relatively significant surge in bankruptcies as banks start to attempt collections against the existing loan portfolio, as well as you know, when deciding when and how to originate new loans. We feel that that's another area where the threshold should be reevaluated and potentially be made more conservative.
In summary, we have learned that lenders were quite free with their spending in recent years, but severe risk to their portfolios was hiding just out of sight. There was a need for better risk management, and COVID is the catalyst for an unprecedented rate of default. We then looked at a number of ways that lenders should always diligently manage their existing liens to mitigate risk in their portfolios. In spite of our best hopes to the contrary, liens were never a set it and forget it proposition. There's work to do to be secure. And if lenders didn't consider these things before, things like lien analytics, lien monitoring, and smart automation, there's a realization that these are even more necessary as we battle through both the human and financial tolls of COVID-19. And finally, we heard how lenders will need to change their view of new loan originations in this new normal. There are new issues in lending that teeter precariously on the edge of unscrupulous borrowing, if not outright fraud. But the right mindset around when to lend, who to lend to, and how to lend, combined with the right technology, can create a secure, profitable lending operation. So it comes down to a very succinct list of to-dos for lenders. Lenders must be nimble in the face of sudden shifts in the lending landscape. Lenders can strengthen defenses against the economic downturn by initiating better ways to assess changing risk. Lenders can pivot to create new policies and procedures to manage existing and new loans. And lenders can initiate more automation and integration that can reduce cost and increase efficiency. On behalf of Wolters Kluwer Lien Solutions, thank you for viewing Managing Your Lien Portfolio in a Post-COVID World. Have a pleasant day.